My name is Jessica Wenger. I'm the program lead for ClimateCAP. I'm so glad that you've joined us today for our panel on investing in climate tech. I know this is a very popular topic with MBAs who are interested in a number of different kind of career paths. And so we're excited to be able to talk with you today with some experts working along the climate tech investment ecosystem so they can kind of share their perspectives on where investment opportunities are emerging, what makes climate companies investable, and some of the skills and the skills and career paths that are going to shape the next generation of climate leaders. We are going to be having our excellent panelists moderated by Lenka Nolan from Northeastern's Mkhize School of Business. And the panelists are going to be introducing themselves in just a second. While we wait for people to trickle in, I just want to mention that we do have a number of different initiatives as part of the ClimateCAP programming. You can learn more about all of these on our website. So I encourage you to check that out if you haven't already, and also to be on our mailing list so you can learn when things are happening. So it's a great resource for the entire time that you're in your MBA program. I wanted to briefly highlight one program, and then I'm going to turn it over to our panelists. And that is our Climate Connect program. It's very impactful to be able to find your community of people who have similar interests in you. I'm sure at your business school, you're going to find your community, but when you have the ability to magnify that across all of the different partner schools within the ClimateCAP network, it can really be impactful. And so we have created these programs called Climate Connects, and it's a great way to virtually meet some of your community outside of your own program who have similar interests that you do. We do have them throughout the academic year, so you'll be able to sign up for them through the mailing list when they come out. But mostly want to highlight the fact that we're going to have our final one of Climate Catalyst this afternoon. That's how we're going to wrap up the program, give you an opportunity to talk about some of the things you've learned, debate some of the things that you maybe want to discuss in more detail. So it's going to be at 2:30 Eastern today at the end of the program, and I highly encourage you to come. Lastly, want to thank our sponsors who have made this program possible, Deriva Energy, Apex Clean Energy, and Environ. And you can learn more about all of them off of our website. But now, the reason you're actually here today, and that's to hear from Lenka, Radhika, Elaine, and Hugo. We've shared their full bios on the registration page for reference, and they're going to be introducing themselves as the panel. Please use any questions that you have using the QA function at the bottom of your screen, and we'll get to those either during the session or at the end. We'll definitely leave some time for questions. And with that, I'm going to turn the session over to Lenka. Thank you.
Jessica, thank you so much, and welcome to everyone. I am Lenka Nolan. I'm a lecturer at Northeastern and an advisor at Greentown Labs here in Boston, and I am delighted to be moderating this powerful panel. We are fortunate to be joined by three very experienced and knowledgeable panelists here, and I've put together a number of questions that will be focusing the 45 minutes of panel discussion around, but then we will have 15 minutes of Q&A time, so you can add questions to the Q&A capabilities of Zoom, and Jessica and I will be moderating that to draw from those questions for our last 15 minutes. Wanted to give you just a sense of how we're going to start off. I would like to give each panelist 2 minutes to give an overview of a few things. Number one, where they are now, briefly how you got there, and then where you see opportunities for MBAs in your ecosystem, or perhaps even slightly outside of that. And if time allows, perhaps a skill or two that you see really valuable in the work you're doing, potentially just to give the MBAs a sense of what is considered valuable today. So, without any further delay, why don't we start with Hugo on the top of the screen? Could you give us your 2 minutes?
Yeah, sure. Happy to. Thanks, Lenka. So I'm Hugo Mkhize. Where I am now is a fund called Climate Investments. We're a specialist decarbonization investor essentially a venture and growth stage industrial decarbonization fund with close to 2 billion in AUM. Our headquarters are technically in London, but we have a global mandate and tend to focus on four key climate tech verticals, being industrials, the built environment, energy systems, and transportation. And we really view investments with the lens of um, financial returns, climate impacts, but also what's attractive to our LP base, which is predominantly the oil and gas majors with some other strategic industrial partners. So my journey, I started in South Africa, background in finance. I spent 5 years in investment banking, doing M&A and capital raising at Morgan Stanley. I then took 2 years to study. Got tired of building financial models at 3 a.m. So I went and did an MBA for 1 year, and I also did a master's in climate science and policy at UC San Diego. And actually, during that time, I was a Climate Cap fellow, so very familiar with this program um, uh, um, and everything that's kind of a part of this. Um, in terms of opportunities for MBAs, um, to be honest, a lot of startups are hiring, especially in the kind of AI adjacent, so baseload energy, compression software, geothermal, kind of all anything to do with energy powering AI. I think there's a lot of hiring going on in that space. And skills, I think something important is to have a kind of T-shaped perspective where you know a little bit about a lot, but you can go very deep in one vertical and show your expertise in a particular space. I'll probably stop there. I probably went over 2 minutes, but that's a little bit about me. Good to meet you.
Thank you, Hugo. And yes, I love that you were a former Climate Cap fellow, which is fantastic. Uh, Great. Let's move on to Elaine.
Thanks, Lenka, and thank you to Duke for inviting me to be part of this. I am a proud Duke alum, so very excited to be back to the community. My name is Elaine Hsieh, and I'm the partner and COO at VoLo Earth Ventures. Just in plain English, it's a venture firm, so we do venture capital equity investment in early stage companies, so pre-seed, seed, Series A, rewriting the economics of the energy transition. So basically, like we're betting on the fastest way to decarbonize the planet is to back solutions that simply win on cost and performance against the incumbents that we're replacing, which, as you know, there's a lot that's wrong with the current incumbent system. So it's pretty much across energy, mobility, buildings, and industry. And we're backing founders that are proving that a lower footprint and a better deal for the customer are the same thing. So every sale accelerates the transition without asking anyone to compromise. My path here before I got to VoLo was not linear at all. Worked in the dot-com time, and then I became an entrepreneur, and then I became an acoustical engineer, and then a green building engineer, and then a utility strategist, and then I ran a climate tech conference called Verge. And then I co-founded RMI's climate tech accelerator program called Third Derivative, where I met Radhika also. VoLo Earth was actually one of the Third Derivative's first venture partners. So there's like this bridge that was interesting in terms of how I got to know VoLo Earth before I even joined them. Several of our Fund One investments came out of those accelerator cohorts. So I'm very familiar with the portfolio. And a couple of the founders at VoLo are actually RMI alumni too, and Radhika is actually an RMI alumni too. So the thesis and the operator mindset were already aligned. But after Third Derivative, I had a stint at the US Department of Energy. I was a senior advisor to the DOE's first undersecretary for infrastructure. And I also was a senior advisor in the loan programs office when the administration changed. When we basically were putting the bipartisan infrastructure law and Inflation Reduction Act non-dilutive funding to work. So grants, tax credits, loans, et cetera. And then VoLo asked me to join the team as we closed our second fund. So it was a natural fit. Where I see I think an opportunity for MBA grads, I don't think there's a shortage of opportunity here, frankly. I think the harder part is knowing how to access it and how to differentiate yourself once you're in the room, right? So the finance and the deal structuring roles, this sector needs in particular, like project finance, infrastructure investing, climate-focused VC, growth equity, corporate development, inside incumbents retooling for the transition, right? They aren't always labeled climate, right? So it takes some digging to find them. And once you're competing for them, a specific point of view on one part of the value chain beats a generic sustainability resume. People need to have some tangible thing to grab into, and I think that that's really important. Two, I'd flag in terms of skills that I think are important. And they're pretty fundamental across the board in terms of the best people I've ever worked with. And I'd like to think that I'm like this, which is first principles thinking and systems thinking. So first principles, because so much of what gets pitched, especially as innovative, is really just repackaged incumbent economics. So you have to be able to break a business down to its actual cost and physics to know if it wins, right? So you really have to think about it at a very base level, like how would you solve this problem from a foundational way of thinking, first principles. Systems thinking, because a decarbonization win in one part of the value chain can shift it can just shift the cost or emissions somewhere else. So energy, mobilities, buildings, industry, like they're all coupled, right? So you have to reason across that whole system, not just deal with the one in front of you. So that's a really important thing. And also in addition, like you're really trying to look at tertiary consequences and interconnected and interdependence and all that kind of stuff, because infrastructure is sophisticated. So you have to be thinking at that level in order to do well.
Thank you, Elaine. Really appreciate you addressing all of those questions, and I think this is so valuable to to the students, because just understanding what you've done and how you've gotten there is so important, and also how you see the future unfolding to a large extent. So, Radhika, thank you so much for being here, and I understand you're going to be bringing in more of an infrastructure perspective. The floor is yours.
Thank you, Lenka. Well, yes, let me introduce myself. My 2 minutes have begun, it seems. I'm Radhika. I'm the Initiative Director of Industrial Programs at Climate Imperative Foundation. Climate Imperative is a global philanthropic funder, so we do grants only, no expectation of returns. We fund the analysis, advocacy, and institutions that really make a market possible before the market exists. And, you can kind of think about it as capital that shows before the capital. And my portfolio is industrial decarbonization and modernization. So I work across heavy and light industrial sectors, think steel, cement, food and beverage, chemicals, among others. And you must be wondering why industry? Well, industry is close to a third of emissions, right? And it's had the least progress of all emitting sectors. So something I'm really passionate about. Where did I land where I am? Well, I started to work in India on climate, where I actually worked with leading Indian CEOs and CSOs, the chief sustainability officers, to advise them on real world sustainability projects, projects that were bankable as well. Gave me great exposure. But then I moved to the US for my higher education. And just for context, I have an engineering degree, an MBA, and then a master's in international policy. So after that, I ended up working with RMI, where I met Elaine and other very brilliant people, where I also co-led something called the Global Cooling Prize, which was an innovation competition to support innovation in the sector of air conditioning. So we were on a search to find a 5x better solution, climate-friendly solution of room air conditioners for the global south, so that everybody could afford cooling without warming the planet. And that was quite successful. Then I helped. So why do I say successful is because actually it's, we've seen deployments of that solution today in India, which is very exciting. I can speak more about that later. Then I helped launch something called the Center for Climate Aligned Finance at RMI, which really advises leading financial institutions on how to align their sectoral portfolios along with sector goals, which got me super excited about industrial sectors, which, are traditionally known as hard to abate, but no longer. Hard to abate, right? We've kind of figured this out. And this is the opportunity that had helped me sort of transition into uh, uh, industry, where I actually help support the creation of the Mission Possible Partnership, which is an entity that's looking at industrial decarbonization across heavy industry and heavy transportation sectors. I was the chief strategy officer there, and worked with business leaders in key sectors to align on sector-wide industrial decarb roadmaps and strategies. And then I moved into climate philanthropy. Just in terms of just building on what Hugo and Elaine have already said, in terms of what skills are really exciting. Of course, the T is very important. You've got to have a great exposure and, your own functional expertise that you add to your role. But just adding to what Elaine said, I think systems thinking is just incredibly important as a skill, and is underrated. And then the other one that I'd add in addition, would be storytelling skills are really important. And I know these are more soft skills, but just they're the most incredible assets that people don't talk much about, but I think have been things that inspire other people around you as well. Ultimately, all skills are transferable to climate issues, and ultimately you're trying to solve a real world problem here. And if you are able to do that, you're successful. Great. I will stop there. I've probably gone over 2 minutes at this point.
No, that's fantastic. You covered so much ground that I know is incredibly of interest to our students. So great. Now we have a fantastic introduction to our three panelists. And now what I'd like to do is begin asking a few questions. We've got about half an hour until our Q&A section. So let me start with the first question. And this I know Elaine can definitely answer, and the others chime in as you see fit as well. So the question is, what actually makes catalytic capital work? The idea behind it being, how do you structure grants, loan guarantees, and equity so they crowd in private capital rather than just subsidized projects that may have gotten funded anyway. So let's begin with that. And you can elaborate on that or choose another angle, but I think this question might begin to spur some really good discussion.
Yeah, I mean, if you pull out, it's a great question because a lot of people in the industry and those who are especially those who are, in the industry now who are listening, that the industry has been talking a lot about the missing middle, first of a kind, or folk, FOAK, or N of a kind, NOK, commercial scale projects, right? It's roughly like the 50 to 500 million kind of gap area. That's a very risky area because you're not de-risked enough yet, but then you're too risky for others who are actually cutting those kinds of checks. And, it's really risky for an infrastructure project finance, and it's obviously not venture shaped enough. And, the returns are too slow. It's too capital intensive. There's a lot of challenges with that sort of one of those valleys of death, and that particular one in particular. So catalytic capital sort of comes into play around this. It also comes into play in many other circumstances too, but I think primarily a lot of people talk about, where does that work? So, there are a lot of non-dilutive mechanisms, but, generally I would say catalytic capital works when it targets a specific identifiable market failure, right? It's a risk that private capital won't price. It's not one it can't ever price. It just steps back once that risk is retired, and it's rather than becoming a permanent subsidy, right? So you want to just be able to like get that help in and then not really be that burdensome. So how you structure the stack is essentially you layer the capital in sort of this, I would call it like a hybrid stack. So each piece like retires a distinct risk, right? So grants or first loss capital absorb the earliest, highest risk. So like technology, construction risk, et cetera. Then a loan guarantee or some kind of non-dilutive funding source that you pay back, like the DOE's loan programs office, but those are much larger loans. They de-risk the debt piece, so commercial lenders will underwrite it. So you get a loan whenever it's like there's a aspect of like you're trying to upgrade your heat pumps or your systems that are already proven and you just need an upgrade. It's not like an innovation thing. So the bank will be like, all right, here's a loan. Or the, state source or the federal source or whatever that provides the loans will be able to underwrite it. And then equity comes in once there's an operating track record. So each layer needs to do a specific job and it's not just stacking on cheap money. Right. And then there's this crowd in test, which, like, would this project have gotten funded anyway without the public dollar? So, like, when we were at the loan programs office, that's explicitly the eligibility bar, right? The office exists for commercially unproven technology that couldn't get financed on private markets alone, right? So, if catalytic capital is going to deals that would have closed regardless, it's not doing its job, right? It's purposeful. And it needs to have a graduation point. So once a handful of like first of a kind projects prove out, then private capital should be able to replicate the model without the subsidy. So the same standardized playbook, wind and solar eventually reached. Catalytic capital that never phases out becomes a permanent distortion rather than a bridge. And then, I saw this directly at the DOE, obviously. LPO loan guarantees paired with the Bill and IRA tax credit stacking gave private lenders and investors this confidence, right? It was obviously an incentive, but we did an incredible 2 years of diligence on these projects. And when it came out, everybody was like, oh, DOE just approved this, then we're all in too. So it sort of gives Wall Street confidence to make it bankable. So it goes from first of a kind clean energy deals and it gets that help in it. I mean, otherwise, nobody would have touched it. And so that's the point of catalytic capital is to just be able to give it that little nudge and then give it the credibility to become really bankable fast.
Fantastic. Uh, who else would like to address that? Anyone like to teach on that?
I could maybe just add an interesting term that I heard at a conference that I really liked was forming a coalition of the willing. So, kind of as Elaine alluded to, different financiers or different funding sources have different things they're looking for. So, if you're funding R&D or kind of some high growth activity, then maybe venture does make sense. But if part of the kind of climate tech solution is just to is to kind of promote jobs or kind of other sustainable promote a sustainable community, maybe a grant makes sense. So basically, for each outcome you're looking to achieve, there's a source of funding that probably is best suited for that, and it's a lot of work. Obviously, this is way more difficult than I'm making it out to be, but it's about getting those different parties who are able to meet those different needs.
And maybe I can add to that. I mean, wouldn't absolutely agree with Elaine and Hugo. I think, when we talk about first of a kind and we're trying to use catalytic capital to get something off the ground that doesn't, usually fit or check the box around, eliminating and managing of all the risks. It's not just one risk. First of a kind is actually a bundling of risks, as Elaine, alluded to. It's the technology risk. It's probably a construction risk. There's an offtake risk involved. There's probably a price risk bundled in. So when you kind of think about these projects which catalytic capital is well positioned to support, you're talking at mitigating a number of risks, and you could do some of them. You could actually, unbundle them and use different instruments to help de-risk different parts of this puzzle. So, think about if you if the risk is, if you're looking at first loss tranches, like, is there someone out there who's about to take the first loss guarantees? Is there performance insurance? Is there completion guarantees that we can use for construction risk? So it's each part of the risk needs to be mitigated separately and unbundled in some ways to really help those first projects happen. So it won't happen just with philanthropic capital or just with the DOE loan program offices, loans or low interest loans. It's got to have different. It's got to have a stack of different, investments coming at solving different risks. I guess that's the point that I take away from this discussion.
Wonderful. Thank you. Well, I know we're trying to, I was ambitious and having a lot of questions, and we won't be able to get deep dive into any of them, but I think just a beginning discussion will be very helpful. Let me go to the next question, which is a little bit more big picture, this idea that 10 years ago, investment often meant wind and solar, right? Today, it means all sorts of things, nuclear, natural gas, to support AI data centers. Carbon removal has become huge. Industrial software. Has the definition of climate investment or investing changed since 10 years ago? You're all free to address this.
Yeah,
Uh,
go Hugo.
oh, I mean, yeah.
You're the old
Thank you.
one.
I was just gonna say, I mean, I wasn't in the industry 10 years ago, to be honest. But from what I've experienced over, I'd say the last 7, 8 years, is that the industry's kind of evolved from, as you said, from clean energy, but also um, thinking about from a macro perspective. In the last, I'd say, 2 years, 18 months, we've seen kind of load growth from AI data centers, and that brings it, essentially, in a way, we're looking at investments that um, with our typical investments, they just have a climate angle rather than being climate tech. And that's why I kind of introduced CI as being industrial decarbonization, where we're looking for solutions that provide operational value add for our LPs potentially. And then on top of that, there's a climate angle, using less resources. So it's less of a focus on we need to find something that meets the climate mandates, and more, how can we actually solve customer problems, and hopefully we do that while also addressing the larger climate issue. I think that's the evolution I've seen in my time in the industry.
Yeah, I tell founders that a language pivot is not a values pivot. We are obviously seeing that, there's a natural commercial pull that's occurring related to AI and energy demand, data center, et cetera. And so there's a lot of deal flow that is related to AI-driven load growth. And, a lot of the capital has then, followed that firm, reliable power. So nuclear, gas, grid infrastructure, et cetera, right? And you're seeing these exits like now, like the liquidity is exciting for the climate tech world, I would say. But at the same time, it's also like, it's not like using climate as a label, but rather just showing like this stuff actually makes a lot more sense from an affordability, profitability, community, pollution is reduced. Like there's flexibility, you're leveraging existing capacity, like all of this stuff sort of makes sense. The challenges, I think, are, really understanding like how do you make these types of solutions that make logical sense, technical sense, like all of these things, how do they scale up faster, given that a lot of these incumbent industries, especially the ones that need to decarbonize quickly, like what Radhika is dealing with in terms of industry, are extremely slow in terms of adoption because there's so much regulatory and sort of incumbent interests. And, there's a lot of stuff that is very hard for a founder to sort of understand. And so a lot of the challenges that we're working through is not, it's, you're seeing like incredibly like more mature, more commercial early stage deal flow, which is exciting, than even like since 2020, 2021, because you're getting a lot of people who, learned lessons from 10 years ago, 5 years ago, et cetera. And you're getting people who exited. So they're more experienced in terms of understanding how to deal with infrastructure and all of those issues. And so you've got better fundamentals, but then, and so we're giving larger checks with more conviction, but they're fewer deals because we have to see that level of bankability up front really early, because that runway for at least venture is like 10 years. And so it has to go quickly. And frankly, our climate needs it to go quickly. So how do you de-risk that as fast as possible? What is the best solution to be able to scale up in a way that's not capital intensive and can kind of fit into existing things, but then upend it and then change how the industry works?
Yeah, I guess just to add to what Elaine and Hugo have said, absolutely agree. I think there has been some evolution and maturity, even in this space, and it's a climate plus plus model. It's just, you just don't find a solution because it's just for climate, but because there are so many other co-benefits as well. And as far as it's solving a real problem, I think including, being more efficient or radically more efficient technologies. Let's take an example of heat pumps. Now, industrial heat pumps are 3 to 5 times more efficient than your alternatives. So it makes business sense, it makes technological sense, it makes climate sense. And I think that's the kind of businesses and startups that are kind of flourishing in this environment. And that's where we've moved because honestly, we were at a different problem. We were solving a different problem on the power sector side with solar and wind, which was basically a cost problem. We had the technology. We were just trying to figure out, how do we get the costs down? And volumes helped get the costs down, and we were able to sort of transition that. But now we're into a different era where we're trying to solve harder problems, for the first of a kind projects. And I think it needs to make business sense. It needs to make climate sense, and it does need to make societal sense as well. Like it needs to be good for the planet, people, and profits.
Fantastic. Radhika, I want to come back to this idea of first of its kind projects. But before I get there, I want to ask a question that is something that relates to this industry, this ecosystem, which I've been in for 30 years. And we used to think of policy as being the only driver for investment and for the growth of the climate sector. But is that still true? The question I had posed was how much of climate investing depends on policy today? Let me just leave it at that. Kind of an open-ended question. Is it still the driver, or or is it making more and more business sense and other factors playing a role?
I think it's a really important question and one that I think a lot about. And I think policy is a great enabler. Um, it really helps people plan long term. So a durable policy certainly gives you an investment horizon and confidence to go invest in things and builds the markets, right? So I think it's super important. But in the time that we're here, that we're living in right now, um, certainty has certainly been an issue around, policy certainties. Like, is this policy gonna, stick long enough? Like these credits, this IRA um, set of benefits, and I think it's been called into question for sure. Um, and I still think it's super important to create market certainty
Mhm.
and to allow for investors to do their job and other sort of capital to come in and help price the risks and help mitigate those risks. Um, and I continue to think that policy helps drive investment, other investment, and that's super important. But in the times that we're living, I feel like there has still we've learned how to deal with the uncertainty and price that risk somewhere in the capital flows. So that's how I would frame it. It's a difficult one though.
Thank you.
Sorry, do we even have time for me to say anything?
Yes, yes,
Okay,
yes.
cool.
Both of you.
Um,
Hugo too. Yes.
Yeah, so I mean, the bottom line is that, as a early stage investor, while policy is incredible in terms of tailwinds, it also can be headwinds. And so you just don't want to be banking, you don't want exposure like that, at least for me. Like if I'm putting in equity, I don't want to bank on subsidies. Right. So, I mean, policy dependence to me isn't disqualifying on its own. Like infrastructure has always leaned on some policy support, especially oil and gas and nuclear historically. I think the real diligence question is the incentive a bridge to structural cost down as the technology scales down its learning curve, or is it the sort of entire margin permanently, right? So the former can still be a great investment. The latter is really fragile. And so geographic and policy diversification is itself a risk reduction lever. I mean, what's interesting and what people don't quite understand is like I track policy a lot globally just because of the nature of like what I've done experience. We thought, oh my gosh, look at all these resources through Bill and CHIPS and IRA and all that kind of stuff. If you actually look at the One Big Beautiful Bill Act from July of last year, people are like, what the heck? Because it obviously rolled back a lot of IRA, EV credits ended in September last year. And, there's residential energy credits ended, like all this stuff. But actually, if you look at the things that were kept, because of the benefits that were felt from the IRA tax credits and a lot of the grants and incentives, states didn't want to let go of those things. So the OBBB is actually the second largest climate law that we've ever had. So if IRA wasn't there, it would have been the biggest. There's actually an incredible amount of incentives still in the OBBB. In the UK, there's the National Wealth Fund. They have a strategic plan that's like de-risking storage and battery manufacturing. And there's a lot related to renewable auctions, et cetera. And then in the EU, there's also the Commission's, I think it was like March, they had a clean energy investment strategy, and that frames like a ton of money for energy investment, specifically in the industrial energy security strategy, as Radhika probably knows. So I think the point is that you're seeing subsidies and you're seeing incentives in many different places. Certainly from an investment standpoint, on my side, I don't want to depend on that, but I definitely want to like move when there are tailwinds because that's a very great opportunity to be able to get leverage.
Thank you, Elaine. Yeah.
And
Hugo.
yeah, maybe just to add, so policy for me basically comes down to I'd say certainty and incentives. On the first point regarding certainty, uh, the kind of role of policy is really to create that certainty, but also um, ensure that there aren't radical changes that's kind of disrupts long-term forecasts. And an example that comes to mind is if you asked us kind of 5, 10 years ago, um, uh, is grant money kind of safe? Everyone would have said yes, but at least our experience with some of our portfolio companies having to kind of do follow-on rounds and raise additional capital because they were banking on, sorry, Elaine, DOE grants for certain funding, and now needing to kind of replace that with other sources of capital. So it's really about you don't want to rely on this stuff, as Elaine said, but the overall kind of structure of how I think about policy is really to create certainty. And then the second point is incentives, subsidies, uh, uh, yeah, both subsidies, but also kind of taxes and kind of sticks on the other end are all about creating incentives. How do you want people to act? So I think those are the really kind of governing roles of policy in my mind.
Fantastic. I mean, I really do think it has to be discussed in when we're talking about this ecosystem. And we also know that policies in the US are going to vary from policies in the EU, Asia, and all around the world. And so, in many respects, if we want to take this to the next level, we have to think where is money flowing? Where are opportunities? And a lot of that may have to do with the policies in place in any given region of the world. So all right. Well, we're running out of time in terms of discussion of the panelists specifically. We do have one, I think we can sneak in maybe one question if we all just address it quickly. And this is related to, okay, I'm going to read this question. Does the first of a kind project to bankable pipeline that worked with renewables apply to heavy industry? Or are we in a different place? Radhika, I know this is something you can address
Yeah.
probably first.
Yes, and I think we've spoken a little about it up front as well. So I absolutely think that we're kind of looking at different bottlenecks here. Like we talked about risk tolerance, and the risk stacking piece, like there's technology risk, there's, first mover risk, there's an offtake risk, there's a number of risks for first of a kind technology that we don't see with solar and wind. That they're much more proven. It's very different. And so I think that is a different model here. This is a different risk tolerance, different bottleneck that we need to ensure that we address appropriately. I would say the other bottleneck that I see on the first of a kind, how do we really get the first of a kind projects going, is the contract tenor. Renewables run on 15, 20-year PPAs with creditworthiness, creditworthy utilities. So there's a lot of that risk that is mitigated now. Steel, cement, and chemicals are procured on 1-year contracts. So there's that discrepancy of like how the offtake is and what is the expectation there. So I definitely think you want to solve for that separately. There are models that are trying to solve for that actually, market instruments, but it's just something that in an ideal world would love to have government be part of those to solve for those contract tenor issues and risks. And then the third one is really, are there customers who are happy to pay the premium? And generally that is not the case for solar and wind. Like it's already cheaper, so it just makes sense. But that's not the case with steel, cement, chemicals. Whenever you are going to go with new technologies, it's going to cost more to the end customer. And while that cost may be incremental, but it does hit. And so how do we create models like demand aggregation to solve for some of these high risk premiums and high green premiums, and ensures things like public procurement that can really help solve for some of this green premium risk that comes with modernizing industries that have traditionally not been touched for decades. And so those are some of the things that I think about when I think about first of a kind projects and what bottlenecks we need to solve and how different they are from your typical renewable energy investments. But I'd welcome others to chime in as well with their thoughts.
Yeah, I mean, when we were at the DOE, that's what our industrial demonstrations and hydrogen hub programs were built to test. So, as Radhika said, government intervention is actually really important in order to really like make that market start to move a little bit more. There wasn't offtake, there wasn't, projects being built, there weren't like a lot of things that were going on. So we wanted to tip our, hand on the scale there to sort of give the incentives to be able to drum up that kind of heavy industry involvement, right? Because heavy industry decarbonization is also, it's more financed on an existing industrial company's balance sheet. So like they're usually retrofitting their own plant, and it's not through like a standalone project finance vehicle, which changes who the capital provider even is. So I think that's the point, is that you've got DOE like coming in, or whatever organization, to kind of come in and be able to help prove the first ton before the private capital comes in. Anyway, the point is that I think you have to de-risk the first project with some kind of patient catalytic capital before the private capital can scale it. And that's not a copy paste from the old folk model for sure, like solar and wind.
Thank you, Elaine. Hugo, would you like to add any last thoughts here?
Um, so so we don't really fund first of a kind projects, but funnily enough, we used to. So we started in 2017 as this kind of the oil and gas climate initiative, essentially a think tank of the largest 11 largest oil and gas majors put together this $1 billion fund in 2017. And the actual initial focus was these kind of really deep decarbonization in industry, like carbon capture, cement, steel. And I think the learning from that and where we are now, why we evolved into a venture fund, is that it really does kind of take time. If your LP base is looking for returns, if they're looking for specific types of operational strategic value, you really need to kind of take that into account. these kind of projects are always going to take longer than you expect them to. So your fund structure almost has to accommodate for that. And we've seen the kind of rise of evergreen funds and kind of longer term thinking funds that are different to your typical venture or growth equity that we do now.
Thank you, Hugo. Well, perfect timing. We can move into the Q&A section. And Jessica, I will defer to you here unless is it fine to just go ahead and address each of these questions? Looks like we have four now.
Yeah, the two of them are similar, so I'll kind of lump those together and then we can go from there. But the not surprisingly, there's a lot of career interest in this space. So we have a few questions around, depending on people's different backgrounds, how can they utilize their MBA to learn about this space more? How does one get started in a career within climate tech investing?
That's all you, Hugo.
Sure, I'll start. So how to use your MBA? I think it's really about exposure and trying to do as much uh, as you can that's aligned to your interests. So during my MBA, I tried to do things like kind of pitch competitions, like entering MIT's Climate and Energy Prize and putting together a startup idea and just seeing if I wanted to be an investor, what's it like on the founder side. And actually, that business is currently running in South Africa with one of my former co-founders. So it's all about how do you make yourself, if you want to be an investor, how do you make yourself well-rounded? How do you increase your network? Because big part of the job is sourcing, and just how do you get your hands dirty? Because another a big part of the job is kind of hustling and trying to be helpful to founders where you can be. So my advice would just be to try cultivate those skills while you have the time. And another thing, please learn AI skills as much as you can. It's such a big differentiator. Agents and all these things that people who are kind of busy on the job just don't have the time. And whenever we see a student in an interview who's able to kind of build up dashboards and stuff like that from scratch using agents, we're always going to be super impressed if you can kind of help us run more efficiently. So would highly recommend stuff like that.
Thanks. Elaine or Radhika, do you have anything to add from your experience?
I mean, so I never got an MBA. I have a master's in engineering management. But I think, I interact with a lot of MBA students, and I'm really impressed with how proactive MBA students are in terms of trying to get experiences. I love the initiative. I think the exposure and the experience that Hugo is talking about is really critical. When you graduate, it's really important for somebody to sort of understand, like, what have you actually done? What did you do to ultimately result in X, right? So I think the point is that if there are opportunities where you can, you know, uh, have not just informational interviews with folks who you're interested, like if you want to get into investing, it'd be great to sort of talk to as many people that work in that field as possible. And then also just say, are there any discrete projects that you think I can support? These are the skills that I'm trying to acquire. I really like to get exposure. I like to understand your thinking about this. And, if you can bring some agentic AI or Claude Code thing or whatever, I'm really cautious about how people are using AI. I think it's really important that we see critical thinking skills before you dive into getting AI to do the analysis for you. I always look at whatever somebody is presenting me that is provided by AI or created by AI or developed by AI with a very, very cautious lens. Only in that, we're still working through what AI is actually capable of and where it's pulling information. Also, dependency on AI is very I don't know. I think I'm a skeptic. I mean, I'm a little old school about it, but I think the point is more just that like we have to be we have to be clear about what we're sharing and how we're using information and not presenting it as is, right? So there's that level of criticality that is really important in skepticism that as an investor you need to have. And so how are you demonstrating that you've really done the thorough homework to be able to get to a place where you have conviction? Those are the skills I'm looking for.
Thank you for that. A little bit of a follow-up question, and this is something that I've heard quite a bit, is this, I guess, chicken and egg of to be a good investor, do you need startup experience? Should you try to do that before you get into investing, or does it matter? So I'm curious to hear anyone's thoughts that have a strong. All three of you smiled.
So I have like a purely finance and I guess academic background, and I agree. I think you need operating experience. Just from so sitting across the table from co-investors and just the best people I've seen in board meetings always seem to draw on their kind of personal first-hand experience. I think it just separates you. Don't get me wrong. I work at a predominantly later stage venture and growth equity fund. So as soon as they saw I could build a financial model with my eyes closed, they were very happy. But in terms of that judgment and really being able to kind of help founders at that kind of one-to-one level, I do think startup experience is valued. And if you just think about the time, if you spent kind of 5 years kind of building your way up in a venture fund or 5 years at a startup, you probably, in terms of skills development on the other side, you probably learn a lot more at a startup. Um, but yeah, if you want to be an investor and you can get in at the analyst associate level, I would also recommend that because they are quite difficult seats to get.
So I would caveat that I would say yes, and operator experience doesn't just mean startup. Um, you can get operator experience at, a larger company, being an engineer in the field, working through things, especially in heavy industry. You need to understand how the market operates in order to build a solution that could potentially upend how that operates, right? So I think and also just understanding like compliance and regulation and, all the different stakeholders that need to be involved and what bottlenecks sort of already exist. I think the best solutions come from people who've suffered the pain. And so if you are looking to build a business, you understand then like I'm solving for X and I have a deep empathy for understanding how the industry currently works. And that's why the solution is better. So I think that that's a very important trait as well in terms of operations.
Yeah, I mean, just adding on to what Hugo and Elaine said, I just agreeing. I think deep domain experience, wherever it is just incredibly valuable. As you kind of sit on the opposite side. And of course, I work at a philanthropy, but I've kind of been on the NGO side. So as I am evaluating proposals or understanding how, an NGO is thinking about it, I kind of have been there and done that. And that is incredibly helpful experience. That it's hard to quantify that, but it's just so valuable.
Thanks. I'm going to ask one last question and then we'll wrap up. But this is kind of a forward-looking question. Is there any kind of climate technology or business model or kind of investment thesis that you're seeing that's in development that you're optimistic about, that you're excited about to see where, that can take us in the next few years?
I can
What are
start.
you optimistic about, I guess, is the great
Something
question.
I'm excited about. I feel like I'm really excited about thermal batteries right now. It's up and coming. It solves for by the way, what are thermal batteries or heat batteries? They're basically a system made with bricks, usually clay, or it's a thermoelectric reaction. But what it does is essentially stores electricity into heat that can be then used as heat in industrial applications. I think that's pretty exciting because this technology is low cost and helps you store low cost electricity at a time when it's available and abundant, and use it when you have to use it, and when there is, peak constraints on the grid. And I think it's a really cool technology that is gaining momentum in the US and elsewhere as well.
It's not really a technology, so I'm going to cheat a little bit, but I'm really excited about growth capital for deep tech. So some of the funds we invest across, like Activate Capital, Decarb Partners, seeing funds that are willing to take that kind of second, third of a kind risk and help deploy technologies that are already proven, let's say, in the US or Europe, and maybe try to deploy them in a slightly riskier market, if you will. I'm really excited about funds in that space.
Thank you. Elaine, how about you?
Uh, I feel so Hugo, just I have like lots of comments around your particular comment. I feel like those particular funds are exciting, but they move too slowly. So I think that there is an ability for that to be better. But I am excited also because it does fill the gap on some level. I think there are a lot of areas of excitement for me. Frankly, it's not like a specific thing. But we have been seeing a lot of really interesting, like critical materials and carbon management and things. We've been seeing a lot of industrial decarbonization, hard tech with the clean economic upside, which I think is just exciting. I mean, anything that gives you like half a gigaton scale emissions reduction is amazing to me, right? And there are lots of different ways to skin that cat. Also, there's obviously a lot of electrification. The electrostate is real. So, electrification replacing any kind of dirty, inefficient legacy system is super exciting. And, for example, Hugo knows this one, Blue Frontier. It's, HVAC system. They're based in Florida. It's just outdoor unit. And, as the temperatures rise, it becomes 90% more efficient. And it uses this liquid desiccant technology. So it's actually built-in storage. So it actually offsets peak load for the utility. So it's not just an HVAC unit that's super efficient and amazing that you could fleet up, but also it's a grid asset for the utility. Like, whoa, that changes the way that the air conditioning industry can work, right? I mean, Radhika knows them too. So I think the point is like the built environment, energy efficiency, grid, like it's all connected. Right. And that's what's really exciting is like, how do you actually like look at it as a system and figure out what is a better solution that actually can make people a lot of money, but also save a lot of people money? And in addition, I think there's also some really cool supply chain industrial software kind of ties to kind of real customer demand. We have a smart wood supply chain. There's like all these really interesting things that we're seeing. So anyway, the short of it is there is no end to the number of really amazing solutions that I find exciting, but I think the ones are like, what are the highest value to society and to your pocketbook?
Well, thank you so much. We are out of time, unfortunately, so we're going to have to wrap this up. But I want to start by just thanking Lenka, Radhika, Hugo, Elaine. Thank you so much for being here today and sharing your deep expertise with this group. This was a fantastic discussion, and I'm sure inspired a lot of questions and excitement from our students as well. So thank you so much for being here. I'd also like to thank our attendees for joining us. We are 2 sessions away from the end of Climate Catalyst, which is just incredible to believe. I think this session was a great way to kind of bring together some of the forward-looking things that we're excited about and how those are being financed. Next, we're going to go into an actual hands-on workshop with En-ROADS. It's going to be really interesting to see how all the different levers are pulled to impact our climate. It kind of brings together everything we've talked about up until now. And then we have that final networking session, Climate Connect at 2:30. So hope we'll see you there. Again, thank you for being here. Thank you to our panelists, and we'll see you all soon. Have a good rest of your day.
Thank you for having
Thank
us.
you.
Thanks.
Great.
Bye.
Bye-bye.